everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. It is my extreme pleasure to once again welcome you to another in our FastGraphs Value U Academy series on financial literacy. Today we're going to have Bill Kay present some very important basic accounting principles, which really are the foundation of understanding how financial statements work, which obviously is the key to understanding how to analyze a business or a stock that you're thinking about investing in. Bill's presentation will be covering topic 4 in our workbook, Basic Accounting Concepts. And one thing I really like about this, this basic accounting stuff is not necessarily the most exciting material you'll come across throughout this series, but it's perhaps some of the most important. And one thing I really admire about Bill is he really presents it in a very common sense, straightforward, easy to understand manner. I think this is the key to understanding and becoming a better investor. So without further ado, let me let Bill present to you basic accounting concepts.
In topic 4, we're going to be talking about the basic accounting concepts. So let's start with why the numbers are presented the way they are. We'll talk about the numbers in the financial statements. There are 3 different branches of accounting, and we'll go through each of those, talk about them. Companies keep 3 sets of books according. Who monitors the compliance with the rules of accounting? We'll go through that. And then we'll get into the first key financial statement, the income statement, showing us the profitability of a company over a period of time. And this is really one of the most important statements. It's going to show us the sales of the company, the cost and expenses that are matched to the revenue and sales, and the difference in accrual-based accounting, profit or loss. And we take the bottom line, the return, the net profit, the net income, the net earnings, divided by the number of common shares outstanding, and come up with that very important statistic called earnings per share. That number drives stock prices, and growth in earnings per share is one of the keys. And we also look at margins. Margins are very important to companies. All right, so who makes the rules of accounting? After the Great Depression, the Securities and Exchange Commission, the SEC, was set up, a federal agency funded by our taxes to regulate public companies. And under the SEC is a quasi-government group called FASB, Financial Accounting Standard Board. There are 7 key master accountants that basically the SEC appoints to FASB, and their job is to make the rules of accounting, the rules we have to comply with. And the rules are called the Generally Accepted Accounting Principles of the United States, or GAAP, and that's with 2 A's. All right, what is GAAP all about? Well, here's a basic overview. It's a standardized system for recording financial events that occur within an organization. It's not a legal requirement. You don't have to do it. However, if your organization needs to be audited, and all public companies are required to be audited by an external outside CPA accounting firm, then the accountants are required to disclose any deviations from GAAP. There's an opinion letter that tells in the back of an annual report if the numbers are in compliance with GAAP. That's one thing I always look at. I want my companies I invest in to comply with GAAP. So when I go through the financial statements, I know basically they are GAAP numbers. So FASB writes the rules that we follow, and accounting rules do vary around the world. I do a lot of international training. The US and Canada are similar, but when I go to the UK, or I work with Siemens over in Germany, or I go to the Orient and work with Mitsubishi and other international organizations, their rules of accounting sometimes are different. as we're going to see as we move forward, we are able to do certain things in the United States like use accelerated depreciation and LIFO. These are GAAP rules that other countries do not use. So while GAAP is used to report the numbers to the shareholders, bankers, and the public, there's another type of accounting called tax accounting. And tax accounting must comply with the tax rules of the countries in which the companies do business. So if you do business in another country, you basically are reporting taxes and what you have to pay according to their tax rules. And U.S. companies have to do the same. So the numbers on the tax return of what we turn into the IRS can differ from what are on the GAAP financial statements. All right, quick overview of GAAP. And I know a lot of you will be familiar with these. Number one, to comply with GAAP, we have to run our business on a fiscal period. That's 12 months. And GAAP says you can select when you want to start. A lot of companies start on January the 1st and go through December 31st. That's kind of called an annual fiscal year. However, many big box retailers like Walmart, Target, Home Depot, Lowe's, they like to start on February 1st and end on January 31st because of the holiday season. H&R Block, they like to end after April 15th, the end of April, and start a new year on May 1st. So GAAP says we don't care when you start, but pick a date, and on the income statement, you'll be starting at 0. These are temporary accounts that always roll back to 0. And after 3 months, close the books, report out your 10Q, the quarterly filing. After 12 months, report out your 10K, the annual filing. All right, if you plan to be in business in the future, GAAP will let you keep your assets on the book at historic cost minus depreciation or amortization. These are accounting numbers. If you're going to liquidate or close an organization, you might have to go back, you probably will, and revalue assets at liquidation value. This could bring down the value of your assets on the balance sheet. We always use a historic monetary unit of the country where we're domiciled. In the U.S., it's dollars. I work with Siemens, it's in euros, and so forth. We are very conservative in accounting, especially GAAP-based accounting. We cannot show a sale or revenue until it's recognized according to our GAAP rules for our industry. You know, for a box retailer, when title transfers to the customer, when you go through the cash register, basically inventory goes down, cost of goods sales go up, and the sale is recorded. Now, if you're a company like Boeing making big jet airliners, it might be percent of complete revenue recognition. So you've got to follow the rules of your industry. But we're very conservative that you follow these rules. Any quantifiable transaction, anything that actually happens, has to be reported in your accounting software and in your financial statements. So this is something companies do. They make sure all those quantifiable transactions are entered in their accounting software before they close the books and create financial statements. We want to be consistent in GAAP. If we buy a new piece of equipment and we capitalize it, we put it on the books at what we paid, we pick a method of depreciation, straight line or accelerated, we lock it into our software, and we follow it over the life of that asset. If we buy another new asset, we might do it a different way. But once you lock in an asset and the way you're going to depreciate it in the number of years, you have to be consistent. Full disclosure, this is a very important one. The notes or footnotes behind the financials. That's the meat of the annual report. I always go to the footnotes and notes to find out how did the company get the numbers and what GAAP rules did they follow. Also, we make some guesstimates in GAAP. We call it materiality. We set up reserves. If you're an insurance company and there's wildfires and you have customers or clients in that part of the country, you might set up a reserve for claims or benefits. You make your best guess. As you move into the future, you could adjust that up or down. But we do reserve for a lot of things in GAAP. High-level overview of the GAAP rules. All right. Who monitors the compliance with the rules? Well, your auditors come in and check you. And remember, if you're a public company, you have to be audited. If you're not a public company, you might get away with a compilation. It's much less expensive, and it's just a quick overview. There might not be a lot of footnotes behind the numbers, and management is responsible for giving the line items and account balances to the accountants, and they do a quick check. Stepping up, they might do a review. Now, if you borrow money from banks, the bankers want to see a complete audit. If you're a public company, you are required to do a complete audit. That's when the accountants come in and really do a lot of checks. And they make sure you're following GAAP, and they sign that opinion letter accordingly. All right, areas of accounting. There's two key areas, and the one we'll be talking about right now is financial accounting. That's looking at the past. This green arrow looking through the rear view mirror of where we've been. The numbers from the past fiscal year or the past quarter. Now, internally, we can do, that's financial, looking at the past. Internally, we can do managerial, planning for the future. There's not a lot of rules and regulations on this. We can do it any way we want. And we basically don't want our competitors to see our planning for the future. That's internal accounting. So we keep an internal set of books, which we don't want our competitors to see. We have a financial set of books. We show the world, the outside shareholders, the bankers, and so forth. Now, the other set of books we talked about is the tax set. And that's what we turn into the IRS. So legally, companies keep three sets of books. The outside set, the financial, the inside set, the managerial, and the tax set, the IRS, tax accounting. And there are some differences between the numbers in these three sets of books. GAAP is accrual-based accounting. If you're going to follow GAAP, you're going to be a larger company. You're probably going to have sales of more than $2 million a year. You might have inventory. You have to use accrual GAAP accounting. If you're a very small business, just starting out, you don't have inventory, sales less than $2 million, you can use cash-based accounting. It's simpler, it's easier. You'll record sales and revenue when you get the money in. You record costs and expenses when you pay the money out. It's just like running your business with a checkbook. It's cash flow in and out. Now, as you get larger, and you're going to follow GAAP, you're required to use accrual, GAAP accounting. So GAAP and accrual are the same thing. We will show revenue when it's earned. Revenue recognition according to the rules of your industry. We will then match during a period of time, usually a month, any cost and expenses incurred. And the difference here is profit or loss. Now, I like to say profit is like food. You need some food to live on, but you can go for a while without food. Cash is king. You got to have cash to pay your bills and stay in business. But really, accrual only looks at profit or loss, not cash flow. And that's why in 1988, FASB and GAAP said all companies that are public must show us a cash flow statement. We'll get into cash flow statement a little later. Now, here's the key. Accrual looks at profitability, not cash flow. So when we look at the income statement, which we're going to do, we'll be looking at profits, not cash. All right. Three key statements. The last one, the balance sheet, the financial health of a business on one day. We're going to start with the key statement, the income statement. Remember, these accounts start at zero, accumulate at the end of a year. We're going to roll them back, put the profits into retained earnings. We might pay dividends. These two are in accrual accounting. 1988, FASB said, show us the third statement, taking accrual back to real cash flow. So today we're going to look at the income statement. It all starts here. The income statement shows us sales revenue, matches, cost and expenses over a period of time. It can be a month, a quarter, a year. The quarterly report to the SEC is the 10Q for quarterly. The annual report is the 10K. Most of my annual reports I get in companies I invest in, I'm looking at their 10K. All right, it shows us on the income statement profit or loss. It's always good to make a profit. But businesses like Amazon for many years didn't show a profit. However, they were generating positive cash flow. Sooner or later, you want to make a profit, and you want to turn the profit into cash as quickly as possible. So the income statement definitely is done under accrual-based accounting, GAAP. All right, we're going to start with the top line and step down. We always start with sales. Now we can start with gross sales, take off returns, discounts, and allowances, but we don't want the outside world to see that. So GAAP says you can start with net sales. And net sales revenue is quantity times price. These are the sales we expect to receive from our customers. Now, what were the costs to generate those sales? Cost of goods sold if you're a manufacturer, cost of sales if you're a retailer. What did it cost you to make it? Direct material, labor, overhead. What did it cost you to buy it from a vendor or supplier? Cost of sales. So we take off the cost, come up with a very important line item called gross profit. That's in dollars. Then we can divide the gross profit by the net revenue or sales and get our gross margin. That's a percentage. We watch these percentages very close from year to year. Then we look at our operating expenses. Some of them can be non-cash expenses like depreciation and amortization. These are things we take off but we don't write a check for. As our equipment gets older, our software gets older. A big category is called SG&A, Selling General Administrative. That includes like marketing, advertising, IT, HR, on and on. Lots and lots of things in SG&A. Now, if you're a company that does R&D, research and development, that also has to be in operating expenses in this category. So we take off operating expenses next and come up with a very important line item called operating profit, operating earnings. Also known as earnings before you take off your interest expense and your tax expense. And we can look at our operating margin. A lot of the companies I work with, they really watch their operating margin. Some companies say we need a 15% operating margin. For every dollar you sell, you can spend 85 cents on costs and expenses, but you have to have 15 cents left in operating margin. All right, under this is called the operating section of an income statement, is the non or other. So we might bring in some interest income. That's always a good thing. We take our free cash, invest it in maybe money market fund or T-bills or stocks or bonds and make some money off of it to stay up with inflation or just have other income, other revenue. If we borrowed money from banks, we have to service the debt and have interest expense. That's the I. EBIT, interest expense. All right, we take these off, and interest expense is a legal deduction before you pay taxes. So now we've got our profit before taxes. We take the T off, pay the IRS our taxes. Right now it's in the low 20s, used to be in the 30s. Who knows if it's going to go up again? Sounds like it might go up to 25 or 28% in the future. Take the taxes off and you get to the bottom line, net profit, net income, net earnings, and a percentage net margin. A lot of companies look at their EBIT and EBITDA, earnings before interest and taxes, very important number. To get the EBITDA, remember we took off depreciation and amortization, but we didn't really write a check for it. We've got that money. Since we have it, we add it back to come back to a number closer to cash flow called EBITDA. And a lot of companies can be valued on their EBITDA. The next thing we are going to look at is taking the bottom line, net profit, net earnings, net income, dividing it by the common basic shares outstanding and get earnings per share basic. All right. So how do we figure EBIT? We take the operating profit and add back depreciation and amortization and come up with EBITDA, closer to cash flow. Cash is king. So the top line, sales, quantity times price. Bottom line, what's left over after all of our costs and expenses during a period of time. Now let's look at Johnson & Johnson, a AAA company, one of the great U.S. companies. And I'm looking at 3 years, 2017 on the right going to 2019. So we're going in this direction. And the first thing I like to look at on their income statement is the trend. Remember, the trend is your friend if it's going in the right direction. So the first thing I'll do is get, and remember in GAAP, they'll give you 3 years in most cases to see the trend. So I like to look at sales. Is sales going up? From 76.5 billion rounded up to 81.6 to 82. So that trend looks pretty good. Sales grew by 6.7% from 2017 to 2018. They grew 5.9 or almost 6% from 2018 to 2019. I like this trend. Then you look at cost, the cost to make those sales. Well, if the trend here is going up, that makes sense because sales are going up, but what percentage? So costs went up less than sales went up. That's always good. And here it went up less too. So if you can keep your cost under control, it's going to increase your gross profits from 51 to 54.5 to 54.5 again. So it's pretty consistent there from 218 to 219. On the bottom line, net earnings, we have 1 year that's very strange. Back in 2017, look at the taxes. I mean, they made 17.7 billion before taxes, but they paid 16.3 in taxes. Why? This was an anomaly. In this particular year, the government and the IRS said, if you've got a lot of profits sitting offshore, we'll give you a tax break if you bring them back this year and pay taxes. And J&J decided to do it. So they only made 1.3 billion in net earnings. That's very low for them. You can see the next year jumped up to 15.3 billion in net earnings, and then 15.1 last in 2019. So these are things we look at. We look at these numbers, we look at the trend. Between gross profit and net earnings are all the costs and expenses incurred. We step down. Now you're going to see on the next slide, we're going to take that bottom line, 15.119, a very important number, it's called your return, divided by the number of basic shares outstanding. So there were 2.6 billion shares outstanding. You divide it into 15.119, and the basic earnings per share was 5.72. The diluted earnings, that is a number that takes into consideration stock options. If a company has stock options, the number of shares go up. You can see from 2645 to 2684. More shares into 15119 brings down the earnings per share diluted to 5.63. So these are key numbers in business, in finance, and affect stock prices. All right, so let's look at 2019 and go through that particular fiscal year. All right, on the last day of their fiscal year, December 31st, 2019, amounts in millions were dropping off 6 zeros. These are big numbers. So we turn on the movie. They started with 0. After 12 months, they had 82 billion plus in sales to customers. That's basically net sales after returns, discounts, and allowances. That's what they expect to get in. And their terms in most cases are net 30 days. So some of this might be sitting in accounts receivable. We can see that on the balance sheet. We take off cost. It cost them $27.6 to make those products they sold for 82. Now we've got $54.5 billion in dollars left after cost. I just summarized all the operating expenses, another 34.4. D&A, cost of goods sold is up above. This would be D&A, SG&A, R&D, all those other operating expenses, 34.4. Take that off. Now you're down to 20 billion in EBIT, as we saw before. You got the other things like interest expense. Take off at 2.7. That's a deduction before taxes. We're going to have to pay taxes on 17.3 billion. You pay the IRS 2.2 billion of that, and you're left on the bottom line with 15,119. So top line 82, bottom line 15. Now, the first thing we do is look at margins. And we like to do this from year to year to see how the margins are going. So we look at the top line sales as 100% or $1. Now, we've got 66.4 cents left after cost. So what percent went out to make the product? 33.6, or rounded up 34 cents went out of every dollar, and we're left with 66.4 cents. Operating expenses ate up another 42 cents, rounded up. We're down to 24.5 cents. 3.4 cents went out for interest and other things. We're down to 21.1 cents. Taxes ate 2.7 cents, and we are left with 18.4 cents. Is this good or bad? It depends. It depends on competitors in their industry. I like to look at J&J against Abbott Labs, against Eli Lilly, Pfizer, other pharmaceutical companies. And J&J has excellent margins. I like companies with good margins. The higher, the better. How do you improve your margins? Charge more for your products or services. Keep your costs and expenses down. Efficiency, productivity. Then we take this bottom line divided by the number. Well, there's the gross margin, operating margin, and net margin will compare to other pharmaceutical companies. Now, the tax rate, if you take 2209 and divide by 17,328, they have a pretty good tax rate, only 12.7 cents. We could get in the notes and find out that why is that below the common U.S. Corporate tax rate. There might be some loss carryforwards. They got rid of a division, and so forth and so on. Now we take the 15 billion divided by the number of common weighted average shares outstanding, 2.645 billion, and there's where you get your earnings per share, $5.72. It's only a statistic, but a very important statistic, as we'll see in fast graphs we watch. We'll take that times a multiplier, a PE, and that should give you their stock price. This is what we'll be doing as we go forward. There's their diluted earnings per share. So we can look at this for different companies and you will see there's different margins. So quickly we're going to we'll compare two companies, great companies in the United States, aerodynamics, space companies, defense contractors before we end this video. Let's just quickly look at General Dynamics for their last fiscal year 2020. These numbers are also in millions. They sold 30, rounded up 8 billion. They had operating, look at that, lots of operating costs and expenses together. I put those together, almost 34 billion. So they've only got 4 billion left in EBIT. They had some interest expense, not as big as somebody like a J&J. They don't borrow as much money. Their earnings before taxes down to 3.7. Their taxes 571 million, and they are left with 3.1 billion. So we look at their margins, and you can see they're not as good as J&J. They only got 8.4, where J&J had 18 on the net margin. So there's their gross, operating, and net. But we want to compare them against Lockheed Martin. That's the way we'll do it. The tax rate here, once again, is below the normal. They got some sharp tax accountants that legally are able to keep it down. There's the number of weighted shares outstanding. There's their basic earnings per share, and they're diluted. And we want to see in the trend over a period of time with these earnings per share. The growth of earnings per share is very important in business. All right, last slide is Lockheed Martin. They are a larger company than General Dynamics. They have more sales. They've got some cost. A gross profit of 8.6 after cost. They got some other operating expenses. They're down to 8,644 in EBIT. They've got interest expense to service their debt. They're down to 8.235. They pay taxes of 1,347. Their net earnings from their continuing operations is 6.888. They've got something they closed out and they took a loss on. So that's a discontinued operation. So we show that as a separate line item and we're down to 6,833. But basically we'll look at the margins, compare them against their competitors, just like we said. Do they have better margins or worse? Well, it's a little better than General Dynamics, and that's always a good thing. Then we'll do the same thing, gross operating net, tax rate, a little higher but still low. Look at the earnings per share and the trend. All right, from here we'll move on to the other financial statements in future videos.